Today, I'm going to go through why you should not be investing in oil and gas. I've talked to a number of people who are real estate professionals, high income earners, or ultimately business owners who are looking for tax savings, diversifications, and opportunities for cash flow amid other investments. They learn about oil and gas and ultimately think this is the next greatest thing. However, they don't know these key things, which you are going to learn in this video. Now, the first thing to recognize is the investment itself, and then also the asset class. Ultimately, the biggest challenge that I see for individuals who have a $1 to $5 million net worth is that they don't have the tools, knowledge, strategies, resources, guidance, or simply the education to be able to understand what to invest in. This challenge alone is why I built the private Wealth Secrets group as part of Investors Guide to Joy. If you're curious about what we do and how we help people as a community, go to investorsguidetojoy.com/wealth. Now, if you are going to invest in any syndication or fund, you need to understand the rules of the high net worth, ultra high net worth, and family office level. And that's simply in terms of how they allocate based on their liquidity. So if you have, say, $100,000 in terms of liquidity, you need to think of that outside of your existing rainy day savings, right? So if you have 6 months saved, you have that. And then outside of that, you have your investable income. That then is going to be what you would invest in. That is to say that you would traditionally not exceed 25% of your liquid net worth. So for example, if you had $100,000 in liquid net worth, so things like cash, maybe CDs, maybe it's cash value of life insurance policies, things of that nature, you're then going to look at that and say, hey, at the maximum, I would only want to put $25,000 into a prospective project. Most projects, whether they're for accredited or non-accredited investors, is going to be $50,000, meaning that you would then need $200,000 of investable liquid net worth to be able to do a investment based on the ratios that at least the family office and others really keep to. A challenge that I see is the $1 to $5 million type of individuals. Ultimately, they just believe that the $100,000 that they have could be spent with the $50,000, and they would eventually kind of make up what, that difference would be. It's a difference between having investable capital and having capital that you allocate for investments. Now, you again want to be sure that you have the right ability to be able to make the investments and also that your cash flow is consistent, because I've also seen how individuals have maybe had the initial chunk, but their cash flow isn't consistent, of which then over time, they're then going to potentially go and ask the operator for that money back. That is the biggest no-no of anything that you could ever do, is to ultimately change how your investment was, meaning that you would go back to the allocator and say, hey, I would like my $50,000, $150,000 back. How can you give that to me? Typically, 9 times out of 10, they won't. And so really the investment that you make really needs to be set and kept so that you're able to continue to invest and live life outside of this investment. Now, I did an interview with a company which was fascinating around secondaries market. So if individuals do have to sell their position due to a life event or some sort of financial crisis, pre-iShares does allow that. Now, that's traditionally for the real estate market, for commercial real estate, and traditionally isn't for other investment types, but it also depends on the PPM that you signed when you did the investment, as well as the operator themselves. I've seen some that are a little bit more lenient and can do it, while others aren't at all. But truthfully, I would not expect anything more than 50% of what you initially invested in. So that's why it's so important that when you make investment in one of these private placements, that you are able to not need the liquidity from it, because of the ability to not receive everything from it, either the short term or the long term in terms of the payout. So keep that in mind and also implement it. If you have questions about this, put them in the comments and let's chat about this and find out a good strategy and tactic for yourself. Now, in terms of the industry and why you should not invest in oil and gas, you should really consider based on the type of investment that you're doing. So there's direct investments where you're actually owning a fractional share of the company. and the production that it's making. There's royalty interest, which essentially is the mineral rights and has nothing to do with the production. There's also stocks and mutual funds that you invest in terms of oil and gas and the oil and gas industry, as well as exploration, also called wildcatting, which be basically poking the hole in the ground based on your research to find the oil and gas reserves that they believe are below the surface. Now, there's different nuances and risks essentially with each of these. And so ultimately, if you have direct working interest, it's similar to a cash flow real estate property. So really the risk isn't very high, but you do still want to underwrite as such. Royalties interest, there's even less risk, but ultimately the returns aren't as great. Think of like a 8 to 10% type debt fund, right? Versus direct investments and working interests could ultimately be a 15 to 30%. While if we look at direct investments or working interest, that would be more a 15 to 30% annualized return. Now, stocks and mutual funds with energy can be all over the board, and truth be told, not extremely versed in them because they are not the most advantageous way to invest in oil and gas and the energy market. And I say that with confidence for some of the investments that I've made in the stock market as well as in ETFs versus the direct placements that I've actually made in the actual industry. And the returns are night and day. And so that's just to say that is a very risk adjusted and safe bet for the stocks and mutual funds, which ultimately then means you're also going to be exposed to that sort of market, as well as that risk tolerance for it, as well as really the upside of it. There's not really a lot of potential predictability on it because it is more of a swing than necessarily a sure thing. Sure thing being more cash flow, right? If we have an oil and gas company that's producing at a 20% annualized return, and all else being equal, it's going to continue in that place. Well, then we can reasonably assume that it's going to be 20%. A stock of a company can look like it's going up, but certainly with an internal piece or a number of different things that happen in and around the organization, even a cancel culture or other challenges, right? That could drastically change the return, even though it could be or has been some sort of metric or predictable outcome. So again, they're all different, but the big thing again is that if you are investing to keep it in the actual project, if you can't do that for the lifetime of the project, then don't do it at all. Most oil and gas investments are going to be, say, a 10 to 20 year horizon. So really, it's kind of a set it and forget it sort of thing. If you can't do that, don't do it. Now, in order to reduce the risk that ultimately you're going to be exposed to, you really need to understand the education around it. So the different risks that you're going to experience and really should be knowledgeable of are geological risks, market risks, operational, and regulatory risks. So let's go through these. With geological risk, even with cutting edge technology, there is not a absolutely guaranteed way to understand the production that's going to come from the well and ultimately the reserves of what it's going to have. There certainly are ratios and ability for that, but even a bank underwrites it to only have a certain percentage that actually reasonably predicts it to be extracted. Now, that's all part of analyzing a deal if you're going to invest in it. But again, it's just a reminder that just because someone says something on a PowerPoint doesn't mean it actually is in reality. With market risk, we think both of oil and gas prices as well as economic conditions for ultimately how things play. Oil and gas can change in high as well as low economic conditions based on other conditions related. For example, the pandemic, we saw a negative temporary price, but then shot up shortly after in 2021 to over $90 a barrel and has then since come down from 77 to kind of a $70, ish mark. That is a big change. And so ultimately we need to recognize that there are different supply, demand, and geopolitical, both on the domestic and international, that affect oil and gas prices. And so if you're someone who watches the news a lot or ultimately is extremely worried about, well, really anything, but also just your investments and you can't do anything about it, because again, you can't just extract it like a stock, you should not be investing in oil and gas. It should be a very set way of an investment. And I did a video on this of the next decade of projected of what oil and gas prices are going to be, where it's going to stabilize and how it's going to come to be. So watch that if you need that, but keep in mind that again, there are different risks that would not be considered with, say, real estate as much. As we think about oil and gas specifically, certainly there's operational risks as well. Things like accidents, spills, equipment breakdown, all these things could halt production and eat into profits. This is just business as usual. So I wouldn't really add it necessarily as a concern or something to underwrite, but definitely with someone's experience as well as understanding the details of the business. Because it's not just the operator, you're also understanding the operations and the geological area of the wells, in addition to, again, the market pieces we just talked about. So keep that in mind that it's not just the shell, it's also the inner workings and the people behind it. Something that sometimes people don't think about. And ultimately, just everything looks good on paper, and then they don't actually take the time to understand more about the equipment that's used. For example, is it a horizontal or vertical well? A vertical well is more consistent. Typically, it's great for cash flow. Horizontal is more for a big swing that kind of comes up and that might stabilize, or it might not even come up at all because, again, you're going horizontally and it's not as predictable that you're going to get really any returns, but you reasonably predicted that you would get some, compared to if you were just wildcatting. That means that you're trying to find new oil. This, as horizontal drilling, would be to find additional oil. So not as a risk, but still is risk. Again, vertical is the least risk, or the most risk adjusted, that is, for your investment. Last thing ultimately to think about is regulatory risks. So governments can certainly change rules. Think of environmental laws or tax policies could increase costs, restrict drilling, and ultimately just hitting like your bottom line. This could also be the opposite, where there's incentives or opportunities for drill, baby, drill, which is really just more of a mantra than necessarily anything beyond that. So there are additional things that you need to consider in terms of how you analyze and should be educated on before you make an investment. But ultimately, once you make the investment, again, keep the investment in so that way you don't have the issue of extracting it and losing the returns that you would have gotten. And you should not be investing in oil and gas if you, one, can't afford it, you can't keep it, and then also you don't understand it. And understand doesn't need to mean you need to have a degree in it, but you should at least go through these 4 different risks that we just talked about. Share in the comments if there are additional things that come up, or maybe if you're currently analyzing an opportunity, we'll reply back and comment and keep a conversation going so that you can keep the best oil and gas investments in your portfolio. Save taxes, live better, diversify with oil and gas and other things. And if you are looking for more detailed information around this, I created an ebook for oil and gas that goes through more information on this to help educate you even more.